Have you ever wondered what happens to the cash value of life insurance when the policyholder dies? Well, today I'll cover the ins and the outs of cash value so you know how to prepare and really what's true and what's false. All right, first and foremost, let's just get clear with this. The death benefit is the death benefit. Whatever the death benefit is at that point is the death benefit. And this can be confusing. So I'm going to talk about the different types of insurances because it's always different depending on what you get. And there are a lot of people out there right now that will tell you that some of these insurances, you don't get your cash value. I'm here to show you that there are actually times that it does happen, that you can actually have more than your cash value and your death benefit together. All right, so the first type of death benefit that you hear about is term life insurance, right? Term insurance is just death insurance. There is no cash value, no buildup of that at all. So when we're talking about cash value, we're talking about permanent insurance. Term insurance is just death insurance. Life insurance comes into two main types. There's universal life and then there's whole life. Those are more the permanent type of insurance policy that you'll see out there. Now, there's a lot of myths about how it really works. You turn on the Dave Ramsey show, he'll tell you you won't ever get your cash value. Heck, I even had some of you guys comment on here saying, you don't ever get your cash value. You know who you are, I know it. But here's the thing, guys, is that there's truth to that. Sometimes, depending on how it's set up, you do not get any of your cash value back. You simply just get your death benefit. This especially is true with universal life. Now, it depends on how it's set up because there's two types of death benefits that happen with universal life. With universal life, now just so you know what it's like term insurance. It's really like buy term, invest the difference. It's like term insurance chassis, but you can add more cash in there to build up the cash value. The problem is that the costs do go up every year, so it can get a little bit tricky. One of the ways to lower those costs over the life of that policy is to do what's called a level death benefit. It sounds kind of like what it is. The death benefit remains level. So if someone gets a $500,000 death benefit, it stays that way forever unless their cash value gets up close to $500,000. Then they have to create what's called a corridor. You know, it's kind of almost like a little cave that goes up and away, right? So it creates that corridor where the death benefit always legally has to be higher than the cash value. It may not be a lot. And yes, in that case, you will get more than just your cash value. But ultimately, the death benefit is just the death benefit. So if you die younger especially, you're probably just going to see this level death benefit that pays out. All that cash value paid into it is gone. Now, why would somebody choose that? You say, wait, what's the purpose if I die and I get none of that money back? The reason they do that is because, like I said, universal life, the costs go up over time. So what happens is they keep the $500,000 as your death benefit and the cash value goes up. What they're doing is they're just having you pay for less of the death benefit, right? You're kind of collateralizing it. It's kind of doing your own self-insurance. Kind of like what some people will say, just buy term, then when you're older, then you just get rid of it and use your assets. It's kind of the same philosophy. Is that as the cash value goes up, say that the cash value goes up to $200,000, it's a $500,000 death benefit, you're only paying for a $300,000 death benefit because the $200,000 is the collateral. So it lowers the cost while the costs are increasing, kind of leveling them off a little bit more. The thing is, I'm not a big fan of that, especially if you factor in inflation. I think that's a horrible way to go, but some people prefer that. The other universal life is called increasing death benefit. It's pretty much like what it sounds like. The death benefit increases as the cash value increases. You essentially get the death benefit plus the cash value. So yes, in that case, you do get your money back on a universal life policy, specifically with an increasing death benefit. The pro is at least the death benefit goes up. It's kind of like an inflation hedge on that. The con is, of course, that now you're paying for more insurance over time too. And so I've seen a lot of those policies where they could run out of money by the time you hit your 60s and 70s, almost like buying term insurance in some ways. The other option is getting whole life. Now, whole life is a whole different animal. It's not that simple with death benefit. There is a cash value component, but the death benefit really is based on how it's structured. Sometimes they have a level death benefit option that they see. We never do that. We're not a fan of level death benefit when it comes to whole life, but we like to see it increase. And now, if you just do a normal whole life policy, many of the critics will say, yeah, but you don't really get all that money back. And they're correct. They're absolutely right that just paying your money into a normal whole life policy, especially the ones that rip you off the most in fees, you might get a bigger death benefit, but the cash value gets kind of absorbed in that. It does go up over time, but it's very slow. So your cash value will go up faster than that death benefit, kind of creating a little less of a benefit for you that way. But if you have one that's designed the right way, we talk about max ROI, infinite banking. The way we design those, you actually get more than what you've paid in and even more than the cash value on your death benefit. Give you an example. I had a client that she was looking at doing $10,000 a year into a whole life policy. Someone had sent her some numbers and she said, hey, can you guys beat it? which by the way, in every single situation, yes. In very few situations, you might say, hey, they would match our numbers. They did exactly what we would have done. Very rare, probably less than 1% of the time we ever see that happen. Most of the time it's like, yes, we'll beat it. In her particular case, the cash value, just doing our policy, apples to apples, doing $10,000 a year, in the policy she was shown, she would only have $5,600 in that first year. In ours, $7,700. She would have about $2,100 more in cash that she could actually use. Now, here's the crazy thing. It was a $170,000 death benefit that we were looking at. That first year, even though she put in $10,000, guess what? The death benefit went up to almost to $190,000. So although she put in 10, the death benefit went up $20,000. So she gained $10,000 of death benefit for free. Not to mention she has cash value in there too. So even if she pulled out most of her cash value, right? Say she pulled out $7,000, sure, the death benefit would come down to like $183,000. That's still more than what she paid in when she started with $170,000. Okay, so I showed her down the road. I said, 16 years, when you're in your 60s, check this out. I said, you put in $160,000, but guess what? The death benefit went from $170,000 up to over $500,000. So it gained an extra $330,000, even though she put in $160,000. Now, someone might argue and say, yeah, but Chris, what was her cash value? I am so glad you asked. Her cash value was well over $240,000. So she had $240,000 of cash value that built up and grew. And remember, she started with $170,000. So she should have had, if it was like an increasing death benefit with universal life, at best, you would think, oh, $240,000 plus $170,000, well, that gives her $410,000. Nope, not with our policies. She actually has almost $100,000 more in her policy. And that's the crazy thing, guys. Like, there's ways to design it. Not all policies are the same. Calling up the insurance company definitely won't get it right either, because they're just going to refer you to an agent and they'll probably send you to somebody that's really crappy. You got to make sure it's not just done okay, but you want it done the best way possible. You want to make sure it's good. So when I tell people, do you want cash value or death benefit, that kind of thing, the question is really, why not have both? Why can't you have the best of both worlds? You have more cash value and more death benefit. And to give you an example, I had a client up in Minnesota. Him and his wife, they were retiring from their practice, and they're saying, hey, Chris, we got these other policies that we've had for several years. It was an infinite banker that sold it to us. It was whole life. What do you think of these? Do you think these are still good or not? And so we said, hey, we'll just do an honest review, and if they're good, we'll let you know and have you keep them. In my mind, before I started looking at them, I said, you know what, you probably should just keep them. You've had some of these for like 8 years. It's probably worth just keeping. Well, long story short, we ran the numbers, even did an apples-to-apples comparison if we moved that money over tax-free into a new policy. And guess what? Even doing apples-to-apples, putting in the same money they're putting in about almost $200,000 a year into these policies between all of them. By doing our policies instead, here's what happened. They end up in 20 years, they would have $2.25 million more of cash value. $2.25 million more, guys. That's multiple millions more. And that's even after starting over on these policies. So we kicked the crap out of any of the things that they had. And guess what? The death benefit was $4 million more in 20 years. So they had $2.25 million of cash value more, and they had $4 million of death benefit. So they got both. They really were able to have their cake and eat it too. So when somebody says, if you look at the critics out there that say, you don't get your cash value back, you'll lose it all, they are only partly true. That is true in some cases. That's true with certain types of universal life policies. And that's even true with some whole life policies too. They're right. The problem is not everything is created the same. They're not all created equal. And not all insurance agents have the same knowledge base or are created equal either. Because either one, they don't have the knowledge of how to do it right, or two, they just don't want to cut their commissions back enough to give you that benefit where you can have the best of both worlds, right? That is the difference there. That's why I recommend, if you ever have questions, you can always go to moneyripples.com and check that out. But understand that if you want to be able to have more death benefit than what you've paid for and still have life insurance while you're alive, be able to utilize the cash value to not just have this retirement down the road or be able to just die with more money, but even better, you can actually use that money while you're alive. Even in the first year, leverage that money that's in those policies to go and invest elsewhere. It could be into your own business. It could actually be into other people's businesses. It could even go into real estate or something like that, or somewhere where it's actual real tangible assets. You can make a lot more money, build your wealth to be much, much greater than just sticking it inside of a policy, earning maybe 5-6% tax-free in a whole life policy. That's great, but you can do so much better than that when you get this to work with your entire plan, when it gets to work as a big picture, where you get to use this money to have a death benefit and cash value, and use that cash value to invest, to increase your wealth, therefore making everything much, much bigger than just doing the traditional crap that some insurance salesman or some financial advisor will tell you to do. That is the key, guys. That is what you want. So guys, if you think this video is great, check out my next video. Should you buy a car with infinite banking? Let's find out.